I'm going to be showing you guys everything you need to know about ICT order blocks, how to identify them, high probability versus low probability, and where to find these order blocks at. OB is just short for order blocks. So we're going to first dive into what makes a high probability order block. The key components is a run on liquidity, a market structure shift, and a fair value gap. So let's dive into this simple example of what an order block is. Then I'll dive into real chart examples. The first key component is that there must be a run on liquidity. If we look at this example right here, you can see that price takes out this level of sell stops right here. When it takes out an old low, that's a run on liquidity. So we need to see a run on liquidity, which occurs right here. What's the next thing? We need a market structure shift. So when price breaks through this high right here, we have a shift in market structure. And then what also needs to occur? Well, in that price leg that goes up and creates the market structure shift, there needs to be a fair value gap. A fair value gap is a 3 candlestick pattern. I'll cover that in a little bit. But within that price leg, when price trades higher and creates the market structure shift, you want to see, is there a bullish fair value gap? That's what makes a high probability order block. It's not what any of these other guys say on YouTube where they're saying it's every down close candle, every up close candle. That's absolutely not true. And ICT completely talks against that in his 2022 mentorship. So it's best to just learn directly from the source, and I guess people that have learned from the source as well. But I always recommend going back to ICT. So this is the first order block right here. This is a change in the state of delivery. A change in the state of delivery is when price breaks above a down close candle or a series of down close candles, and this starts the delivery to the upside. So once you get this signature in price action, the market is going to start offering higher prices. So it's going to target the buy stops above here, and then also the buy stops above here. The change in the state of delivery has gone mainstream on YouTube. A lot of people are talking about it, and half the people don't even know what they're talking about. So again, I recommend going back to ICT, but from what I've learned from him, a change in the state of delivery is when price will break above a down close candle or series of down close candles, and that changes order flow, and it shifts price from a sell program into a buy program, and the market starts offering higher prices. So it's going to start reaching for old highs because it's a signature in algorithmic price delivery that price has switched into a buy program, and smart money's already long. So if they're long, where are they going to want to target? They're going to want to target above old highs. So now you're thinking, well, damn, why is above old highs significant? That's because there's buy stops above old highs. So it's an area for smart money to sell to buyers above the market price. So once we get this reversal and this change in the state of delivery, price can continue higher, but along the way, you're not always going to see this run on liquidity. So what I've noticed is that price can still create these high probability order blocks, not doing these runs on liquidity, but still creating the fair value gap with the order block. So don't worry, I'm going to dive into real chart examples. It's all going to make sense very soon. In this price leg that goes down, you're looking for a down close candle or a series of down close candles. If there's a series of down close candles, you're going to mark that out. When price retests that, you want to see a fair value gap in this price leg right here. When price retraces into that, if price is already reaching for buy side liquidity, if it's already heading for up here, this is an area where the algo will refer back to, retest this support, continue higher. Same idea right here. Price returns back into the order block. I'm going to show you guys exactly what this looks like on a real chart. So one thing that you want to pay attention to here is see this move down from this high to this low. It has retested this blue order block. When price breaks higher and closes above this previous high, this move down, you're looking for a down close candle or series of down close candles, and that's an order block. But when an order block retests an order block, it's classified as a propulsion block. We're going to dive straight into that in a minute, and I'll explain more on that. But essentially, a high probability order block at reversal points is going to be a run on liquidity, a market structure shift, and a fair value gap. We have that right here. Run on liquidity, market structure shift, fair value gap. And it closed above the down close candles, which we're going to dive into. That's what causes the change in the state of delivery and the shift from sell to buy program. Once you have that along the way, until price reaches the buy side liquidity above the market price, which is going to be this high and also this high, you can refer back to down close candles along the way. People don't teach you this because they don't truly understand how the algo works in here. Once that reversal point happens and once it's reaching for buy side liquidity, that's when you refer back to these random, what looks to be random down close candles in here. It's actually the algo returning back to order blocks and then reaching for buy side. So we'll dive into what that looks like in a bearish example. I'll go over this really quickly. Same idea, price runs liquidity, takes out this old high right here. So it does a run on liquidity. What do we need next? We need a market structure shift. When price breaks through this low right here, we do have a shift in market structure down. Okay, what do we need now? In this price leg that created the market structure shift, so the low that created that shift down, right? You're looking for a fair value gap in that low, in that price leg down. So if we have a fair value gap in there, it meets the criteria. Because number one, it's taken out buy side up here. It's created a shift in market structure, and it has a fair value gap. So once it closes beneath the consecutive or one down close candle in here, it creates a change in the state delivery, and the market will start offering lower prices. So it's going to want to reach for sell side liquidity. And that's exactly what happens. As it's reaching for the sell side liquidity, you can refer back to order blocks along the way, and up close candles will act as resistance until it reaches for the sell side liquidity, which we have beneath this low, which we also have beneath this low. This move up that has retested this order block, so I'll make this one big. See this move up that retested this blue area? When price leaves that price area and trades lower, in this price leg, the consecutive or one up close candle will be classified as a propulsion block because it's an order block that retested an order block. It's still an order block, but ICT just classifies it as that. If you guys are interested in seeing more content from me, I do have a Discord community, which will be the first link in the description. I do share on the S&P 500 and the NASDAQ pretty much every day where I believe the market is drawing towards. So it's not a buy and sell signal service, but I do show you guys where I think price is headed. So this was the NASDAQ in the beginning of the week. We did have a bullish 2022 model. I was suggesting that my eye is on the buy side. Buy side is above old highs. Looking for price to draw up into there at 9:30 open. We did have a nice push higher. So on Monday, there was some nice setups. Yesterday, we did have another very nice setup on the NASDAQ where it was suggesting a market maker buy model, looking for order flow to be bullish until price reaches that 16,300 level and the 16,345 level. So I said I waited for a low risk buy of the market maker buy model for confirmation that there was a smart money reversal. If you don't know what that means, I was just waiting for confirmation of higher prices, and we did deliver to that first target, and then we delivered to the second target later in the day. Now, if you look at ES, we did have another nice 2022 model. If you look at this order block right here, these consecutive down close candles, when price returns into that, that is a long right there because the narrative of the higher time frame was bullish. So when price retraces into that order block, that's a potential entry. Notice how price runs up again right here, returns back down. This is an order block as well. So that's where my entry was, around this price area, and price started to continue higher. If we look at that, that is where I did enter. So price retested the order block, got off at the buy stops. Another thing, I do drop exclusive videos every week. Last week we talked about SMT divergence and changes in the state of delivery. Yesterday I made a 25-minute in-depth review covering those trades that I took yesterday. And I also covered some ICT gems in there, really trying to show Discord members what's low probability versus high probability conditions and conditions to avoid, because that's the most important part of all this. If you guys are interested in that, check out that first link down below. So run on liquidity, a market structure shift, and a fair value gap. Now enough of these examples. Let's dive into real chart examples so you guys can identify this on your own. If we take a look at this example on the NASDAQ on the 30-minute time frame, I'm looking to see price run out an old low or a level of sell side liquidity. So the key structures that we're looking for is a run on liquidity, a market structure shift, and then also a fair value gap. So we have this old low right here. This is sell stops beneath old lows because that's where retail will have their sell stops. We're looking for a run on liquidity. We are looking for a market structure shift, and then we're looking for a fair value gap. If we look here on the 30-minute time frame, see how there is a down close candle? One thing to note, bullish order blocks are always going to be down close candles. Bearish order blocks are always going to be up close candles. So now we're just following the criteria, right? We're looking for a shift in market structure. We have that right here. We're looking for price to create that shift in market structure. It does it when price breaks through this high right here. And by right here, I mean where I just drew that black line. As price creates the shift in market structure, is there a bullish fair value gap? So a bullish fair value gap is going to be a 3 candlestick pattern. We have candle number 1, 2, 3. Between candle number 1's high and candle number 3's low, notice how just the body of candle number 2 is traded in that area. This is a fair value gap. This candle 1's high and this candle 3's low, their wicks don't overlap. That's the signature you're looking for in here. And the reason that's what you're looking for is because it shows institutional sponsorship to the upside. It's smart money's footprints. It's the displacement away from the sell stops. So we have the exact criteria right here, and this is how you can figure out smart money reversals in market maker buy models. So I'm dropping a gem here. This is something you want to note. Because price has taken out sell side liquidity, we have an order block, and we have a shift in market structure. So when price breaks above this down close candle, that creates a change in the state delivery on this candle right here. What will occur after that is the market will start offering buy side and will start targeting old highs. Notice from there, when price breaks above that specific down close candle, it starts to target this high, and eventually reaches for that high. So that is why in the Discord, we have been bullish the last few days, because we had a bullish change in the state delivery down here. The market was offering higher prices after taking out that high. So a bullish order block, if there is one down close candle, it is going to be one down close candle. See right here how we have a down close candle, then an up close candle? Well, in this example, this is the bullish order block, this down close candle. ICT typically marks out the open of that. If there is a large upper wick, he will draw out the open and the wick. I'll show you guys examples of that in a second. So this down close candle, the entire thing is the bullish order block. The opening price is the sensitive point of the order block. You can draw out 50% of the order block. So you can draw out 50% and extend that out. If you're bullish, you don't want to see price break beneath 50% of an order block. ICT classifies this as MT, or mean threshold. So when price returns back to the open, that's obviously the sensitive point, just like we talked about, and price expands away from that. Price starts to expand higher. Goes higher, higher, higher. This is when it's already offering higher prices. We have a market maker buy model targeting the buy side above. Again, you will see this signature every time at a smart money reversal level. Price continues higher. Notice how right here we can't really see a down close candle with a fair value gap. As price is trending higher, targeting this high, all we're really looking for is we're looking for a down close candle with a fair value gap. So if we go back to this, this is when I start to ignore the run on liquidity, because I already created it down here. Okay, and if it's delivering from the sell side to this high, it doesn't need to run liquidity again, because they already took out the sell stops over here. So really what I'm looking for along this trend until it reaches the buy side liquidity up here, I'm just looking for a down close candle with a fair value gap. So if we look on the 30-minute time frame, we have a down close candle here, but there's no fair value gap. So what you can do now is scale down to the lower time frame. When you don't see an order block on a higher time frame and you just see a down close candle, likely there is going to be an order block on a lower time frame. So when we go to a 15-minute, see this down close candle followed by this fair value gap right here. Okay, that makes this down close candle a high probability order block. So when it returns back down to the order block, we're going to mark out the opening price. That's going to be a sensitive point. You could also mark out the midpoint, which is mean threshold, but you'd normally, if you're really bullish, I don't even want to see 50% traded to. And if it closes beneath it, then I have to consider that I have the wrong bias. So again, if we scale down to a lower time frame, we do have a high probability order block in here. Again, the down close candle followed by the fair value gap. If we look in here, we do have a down close candle followed by another fair value gap right here. So notice how we do have this down close candle, then there's an up close candle right here. From what I've seen, ICT will just draw out the opening price on this down close candle, right, and ignore this up close candle, because really this started the delivery down to here and then it expanded away from it. Since it does have a large upper wick, the down close candle is the bullish order block, but since there is a large upper wick, sometimes the algo will just refer back to that last high and then expand away from it. So in this instance, since there is a large upper wick, ICT would draw the opening price to the upper wick. And you can see price refers back to that upper wick and then expands away from it. So now we do have a down close candle in here, and then price runs for the buy stops, but there's no fair value gap on this time frame. So what did we just talk about? Go down to a lower time frame. Notice how here we do have, if we let this skip ahead a little bit, you could see that price returned back to this down close candle right here and then expanded away from that. So this should actually be on the opening price. So that the opening price of a down close candle is the sensitive point. Notice how we have a down close candle followed by a fair value gap. That makes this down close candle a high probability order block. So when price returns to that opening price or the upper wick, right, these are sensitive points of the order block. You can see price respects it and then expands away from it. If we do look on this time frame, on the 5-minute, okay, I'm going to delete some of this other stuff. Notice how we do have these two down close candles. This is where some people may think it's tricky, but it's really not if you just stick along for a second. When there is a singular down close candle, I am just marking out the opening of that singular down close candle. You could also mark out, again, like we talked about, the 50% level. In this, it's respected. That's a bullish algorithmic signature. So here's where some people may think it'll get a little tricky, but it's really not if you just stick along. When there is two down close candles in a row, right, I'm going to mark out the opening price of the start of the consecutive down close candles. Notice how in this one, there's just a down close candle, then an up close candle. Well, I'm just going to mark out the open of this down close candle. Since there is two down close candles in a row, well, I'm going to mark out the open of where it started that delivery down for the two down close candles. I could also mark out the upper wick of this. Notice how the algo refers back to that upper wick and then starts to expand higher from there. That is a bullish order block. Here's more examples of what it looks like when there is multiple down close candles. Notice how in this one we have 1, 2, 3, 4, 5, 6, 7. Okay, we have 7 consecutive down close candles. Well, I'm going to refer back to the last one before it started that delivery down for the consecutive. Okay, and I'm going to mark out the opening price of that. The algo will refer back to that rather than all the way down here. So notice how it consolidates around this area and then it expands away from it. Similar idea right here. We do have 1, 2, 3, 4 in a row. So I'm going to mark out the opening price where it started that consecutive down close candle, move to the downside. Price breaks above that, changes the state delivery, pulls back down into the order block, then expands away from it. So that's an example of multiple OBs in a row. Let's dive into a bearish example. Here we do have a high probability bearish order block at the smart money reversal level. So again, we're looking for a run on liquidity, a market structure shift, and a fair value gap. This level above this old high is buy side liquidity or buy stops. So we're looking for an old high to get ran. It gets ran. Okay, we have these 4 up close candles in here. When price breaks down, okay, I want to see, is there a shift in market structure? We have that right here. Is there a fair value gap in that price leg that creates the market structure shift? Yes, we have that right here. So we have a high probability order block because it's ran liquidity. It's created a shift in market structure. And really, for a valid change in the state delivery, see how there is 4 in a row right here? Well, I'd wait for price to close beneath all 4 up close candles. So once price closes beneath the order block, see how there's 4 up close candles in a row? Once it closes beneath this one right here, that creates a change in the state delivery, indicating a potential smart money reversal. And what this indicates is that the market's going to start offering sell side. So it's going to start targeting these old lows. So if you do look on my Twitter around, I believe it was like October 15th-ish, I was looking for lower prices. The idea here is that this indicated the change in the state delivery for us, and it indicated that these lows down here would get targeted. So this is a signature to look for at reversal points, a change in the state delivery. So notice here, the opening price is not respected. Well, that's because we were in a lot of chop. So in this instance, I can mark out 50%, right, of this order block. So from the low to the high, notice how I'm not doing it on this specific up close candle, but I'm rather doing it on the entire 4 up close candles. That's how you would draw a mean threshold on a consecutive order block right here. So it's one order block, but it's just consecutive up close candles. Now, the last up close candle is the sweet spot of the order block. So notice how the algo retraces back up here and it retests the lower wick, and more specifically and more importantly, the opening price of that last up close candle. Sometimes when there's deep retraces, the algo will reprice back to the last up close candle, and that's going to be the most sensitive point of the order block because this started that delivery lower. Notice how it retests the order block. This up close candle, notice how it's just one. Price breaks beneath it, creates a shift in market structure, which we do have right here. And it does have a bearish fair value gap. So that's extremely important. A lot of people miss that out where there should be a fair value gap and a high probability order block. And that's straight from the 2022 mentorship. So when price closes beneath here, right, this is a valid order block. Now, some people may look at this and say, well, I don't see it retesting the order block, but it does, because it closes right here, trades lower, and then if you look at this wick right here on the 4-hour time frame, it wicks into that open of the order block and then expands lower. So here we do have another order block. This is a gem for you guys. At smart money reversals, you want to look for a run on liquidity, a market structure shift, and a fair value gap. So this is the signature that you look for at smart money reversal levels. You're looking for a run on liquidity, a market structure shift, and a fair value gap. So once price closes beneath the order block, the 4 consecutive up close candles, I'm going to mark out the open of that. When price closes beneath it, it's a change in the state of delivery. Now, the market's going to offer sell side. It's going to start targeting these lows over here. Now, until it does that, up close candles tend to act as resistance along the way. So if you notice, we have this up close candle right here. We have these 2 up close candles followed by a fair value gap to the downside. So in this instance, I would mark out the consecutive up close candles and also potentially this lower wick. And why is that? Because we have consecutive. If it was just an up close candle in here and this was a down close candle, I would just mark out this up close candle. When it's consecutive, I focus on the open of that consecutive move to the upside. Could also mark out the lower wick since it is pretty big. So notice how it doesn't retrace back up to that. That happens. That's okay. Over here, you may say, well, why does this one fail? And the reason that is because it already took out the target. So it needed to take out the sell side liquidity here, here, and here. It took that out. So after it takes out the sell stops, it starts to reprice back higher. This isn't an instance where I'd trade that order block right here, unless I was really, really anticipating for lower prices. But this would be a low probability one because it already took out liquidity, sell side, and then it returns back to the order block. It's likely to break above that, which it does right there. So that's going to be it for this video. Just to recap real quick, a high probability order block at reversal points creates a run on liquidity, a market structure shift, and a fair value gap. We do have that right here. Run on liquidity, market structure shift, fair value gap. That's the red shaded area. Once price closes beneath the consecutive 4 up close candles, that creates a change in the state of delivery, and the market will start offering lower prices. Until it reaches the sell side liquidity, up close candles and high probability order blocks along the way will be referred to as resistance, just like we have right here. Notice how we have an order block retesting this order block. This is a propulsion block. It's still an order block, but it's just classified as a propulsion block. Along the way right here, right, all I care about is just up close candles with fair value gaps. I don't necessarily need to see it take liquidity because it already did that job up here. That's going to be it for this video. Hopefully you guys found this insightful. Catch you guys next time.